Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, May 15th, 2020. And our top stories today: public pension plan troubles deepen and changing times for working from home. Joining me now to discuss this and a lot more, Devin Banerjee is the Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, welcome back to the program.
Thanks, Jeff. Always good to be with you.
Yeah, it's great to have you. Lots going on, I would imagine, on the LinkedIn platform. Lots of conversations. What's top of mind for you and the financial services team this week?
Absolutely, Jeff. Another busy week in the news and on LinkedIn. I want to start by talking about public pensions. We had some new data come out this week about just how dire the situation has gotten for public pensions, for their investment portfolios this year. Now, of course, public pensions provide for the retirement of millions, tens of millions of Americans. Here in California alone, it's almost 5 million Californians. These are public sector employees, teachers, police, firefighters. And going into this pandemic and this now economic downturn, public pensions were already quite severely underfunded. Their plan obligations, which you can think of as kind of a present value of their future obligations, were about $8.9 trillion, and they're facing a shortfall, their plan assets, a shortfall of about $4.1 trillion. That was going into this crisis. Then during the first quarter, the recent data that came out this week shows performance for the first quarter. The median public pension lost 13.2% in the first quarter. That's the worst performance for a quarter on record for U.S. public pension plans. This is according to Wilshire Associates. This exceeds the previous record of about a 13% loss during that fourth quarter of 2008, during the last crisis. Now, the results are actually also likely even worse because there's about a 1 month lag for these pensions private investment managers, the private equity firms, the real estate managers, et cetera. So, if you think about how these plans are funded, three big buckets. There are employer contributions, so contributions coming from governments and municipalities. There is employee contributions, so withholdings from paychecks going to workers. And then there are the investment returns. And if you think about what's happening right now in this environment, all three of those buckets are under pressure. Government revenues are under pressure, taxes on sales, taxes on income. Those are under pressure as spending drops off, as unemployment soars. Employee contributions under pressure in terms of salaries and income, and investment returns, as we just talked about, really under pressure. So a real trifecta here, hitting an area, as I said, that provides for the retirement for tens of millions of Americans and was already severely under pressure going into this crisis.
Yeah, I think this shouldn't be a shock to anyone who's been following the show or who's been reading the LinkedIn This Week in Finance newsletter, or really for the last decade. I mean, this has been an issue that has been kind of rearing its head, and it kind of echoes what's happened, for example, in the multi-employer space. Those are union plans that we've also talked about. Look, I mean, it's not inconceivable that with market downturns, you're going to have and delaying taxes till July in a lot of cases, at least at the federal level, and in some states. Here, I'm in New Jersey, we're delayed paying our taxes, or can delay paying our taxes until July. So it seems like receipts are going to be down. It just makes sense. What I do want to urge caution about is we shouldn't just throw in and say, well, let's wash our hands of the pension system and let's go all in on defined contribution plans, because that would in itself have a adverse effect potentially on recruitment. A lot of people who go in to be police and firefighters and emergency personnel and work for the government, they do that to get the pension. So there's a little bit of a disincentive if you don't have that. You don't have the career professionals that you really need to do the work that they're doing right now on the front line. So, it's not inconceivable this is going to happen. And look, we're just going to have to grin and bear it and deal with it. And look, like everything other part of the economy, this will have to come back over time.
Yeah, and what we've seen public pensions do over the past couple of years is change a lot of those actuarial assumptions going into their accounting. So their investment target return, for example, their actuarial return target, which is kind of an assumed investment return to match their assets to liabilities into the future, we've seen them bring that down from, I think, about a decade ago when I started covering investing. It was hovered around 8%.
Yeah.
They brought that assumption down to about 7.5%, now down to about 7% in many cases. That's an annualized return. If you think about where interest rates are now, and yields on other assets, that is a very tough bogey, a hurdle to meet. And as they bring that return target down, they need more assets right now to meet those future obligations. They don't have those assets, and so that underfunded gap becomes even larger. So I'm curious, Jeff, if you think for the current kind of investment plan and the current kind of pension accounting system, what other steps these pensions could be taking? Because, as I said, those three buckets are really getting hit right now.
Yeah, I think it's a challenging market for everyone. I think you made a good point about the private assets at the beginning of your segment. And by the way, I love how you turn the tables on me. I'm supposed to be the interviewer, but in any event, and you do a great job.
This is an area where I know you've spent much of your career advising some of these organizations, and it's really, to me, a quandary. How they proceed from here when all of these buckets are being hit.
Yeah, no, I was just kidding, and I know you do your own show on LinkedIn. I was just joking with you. Look, I think how you deal with it. Number one, you talked about private assets. That is a way to increase your returns, alpha returns, and we've seen a lot of organizations do that, especially in the private equity segment. Hedge funds haven't had a great set of returns, although I believe I read recently that April was a good month for hedge funds. So you can look outside of the traditional public markets. That's one. You could try to float a bond in order to make up some of the contributions. But again, you're just really pushing the debt into a future generation. Look, a lot of governments have done that. I would just point out that the people who run these plans, the trustees, the boards, and the administrators have planned, and they have to make payments on a month-by-month basis to existing retirees. They, in a lot of times, have strong cash positions in order to make those payments. I've done some interviews on that. I know you have as well. So I would just urge caution, and let's not jump the gun and start floating ideas about pension debt obligations, closing the retirement plan and going to a DC plan just yet. I think there's a lot of work to be done, and we need to see how markets perform over the long period of time. And that's what we tell 401k investors, right? Think about the long term, and I think we need to not rush to judgment.
Yeah, I think you're absolutely right that the people running these plans do think very long term. One of the people I interview most frequently is Chris Ailman, the Chief Investment Officer of CalSTRS, the teacher retirement system here in California, second largest public pension plan in the US. He thinks extremely long term, a horizon of 30 years, 50 years into the future. And then I would just support another thing you said, which is the move into alternative assets, not endorsing, of course, but saying that is what public pensions have been doing, kind of going out the risk curve to try to achieve higher returns, higher yield. They're kind of a liability-driven investment model where they need current income to make those monthly obligations, and those private equity investment managers and real estate investment managers can provide those distributions in a sort of current yield format. So I remember a decade ago when I started covering the private equity industry, seeing checks and commitments from public pensions of 200 million, 250 million was considered really large and kind of the higher end. Now you see some of the bigger plans cutting checks of 500 million in one go to one private closed-end fund, even 750 million from some of those larger plans for those larger mega private equity funds. So things have really changed, and we've seen them plow into alternative assets since then.
Yeah, I mean, I think if people are often quick to jump and point fingers, I would just look in the mirror, because we're all in some way guilty of all this. So we need to all step in and make compromises and not jump the gun, because I think the last thing you want to do is police your own town, fight your own fires, do those types of things. Look, I think we're all going to have to compromise. We'll figure it out in the next few quarters and months as this pandemic as we return to some level of normalcy. Well, Devin, that was a great segment. I'm going to hold you over because when we come back, a little bit of a lighter topic, I think. We're going to talk about working from home. Things seem to be lightening up on Wall Street in the financial services firms, but we're going to let Devin talk about this when we come back right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive FIBREX composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee, Senior Financial Services Editor for LinkedIn. Devin, thanks so much for sticking around with us this morning.
Absolutely, Jeff.
Always a pleasure chatting with you. And on a lighter note, maybe, pensions, we love pensions, both of us, and I think the audience does appreciate that topic. But on a lighter note, I know you wanted to talk about work from home and maybe the times they are a-changing for some of these financial services firms.
Absolutely. This is something we're all thinking about right now. It's top of mind for everyone, which is how do we work from home most effectively? When do we maybe return to the office? Could we work from home forever? And what we're starting to see in some really interesting data, both from us here at LinkedIn as well as some other data sources, is that among the industries thinking about these questions, financial services is actually one of, if not the most comfortable industries working from home, the most confident about working from home going into the future. So we at LinkedIn yesterday, Thursday of this week, released our latest Workforce Confidence Index. This is a bi-weekly pulse of how workers here in the US, and actually we run this internationally as well, are feeling about their jobs, their careers, and their personal finances. And we saw finance really at the top of that list of industries most comfortable working from home, right up there with software and IT actually. So 82% of workers in finance say their industry can certainly be effective working from home. 83% said they themselves as individual workers in financial services can be effective working from home. As I said, right up there with our number one industry, software and IT on that question. Also this week on Monday, PwC released some data that really dovetails with this. They were asking CFOs about positive outcomes coming out of this pandemic and this crisis. And financial services outpaced all of the other industries where they surveyed CFOs. So both on the question of resiliency and agility of their industries coming out of this crisis, as well as their confidence in their work flexibility situation. So again, financial services really outpacing those industries. And I had a chance to catch up with Tim Ryan. He's the US chairman at PwC. And he really pointed to a couple of factors really driving financial services in particular on this topic. Number one, they've spent the past several years, 5 to 10 years, really investing in their technology. They did so thinking about clients and customers in mind in terms of automating those processes, making it lower cost, more efficient for clients and customers. And now they're finding that those investments in technology really transfer over to how their workforces can communicate with each other and can work from home, communicating with managers across the organization. Number two, he pointed to is, of course, the nature of work in finance. Let's be honest, people in finance are not manufacturing cars with their hands or performing surgery with their hands. It's basically done virtually, by phone, over the internet, et cetera. So the nature of work really lends itself in this industry to virtual work. And then number three, which is similar to number two, is virtual work is not so new to this industry, again, because of the nature of work. And so that goes to the resiliency and their agility. They're able to still make phone calls to clients. They're just doing it from home, not the office, still email people. They're just doing it from home and not the office. So really interesting as all of the workforce and managers across the board and C-suites across the country are thinking about returning to work. We're really seeing the highest confidence in the financial services space.
Yeah, I think you're right. And I think it's a long time coming. And I think there's, people kind of dug in and think you got to be in the office. The same people, by the way, that say you got to dress up in a tie, a shirt and tie, and nice pleated pants or a nice skirt or pantsuit, whatever. I don't want to get some angry letters, but you know what I mean, like dress up. And I think the only danger, and I say this kind of tongue in cheek, the only danger now to working from home is if you're there with your kids and your spouse, because we're in week 9 as we're recording this. And I got to give, number one, working with a spouse and being in the same compressed environment. I miss my coworkers. I miss being able to go out and say hello to you when you come to New York. I think that's challenging. But for those people who are parents, there's an additional layer there, I think, that is really underappreciated. And that needs some resolution.
That's absolutely right. There are many complicating factors, both for people in their home situation. We're also seeing some pockets of the industry. I don't want to paint the industry with a broad brush. There are some pockets that are not so comfortable working from home. This was not in our data or PwC's data, but there were some interesting stories I've read, one in the Financial Times about hedge fund managers really concerned about complacency as their employees are working from home. So very on brand in the hedge fund industry, I might add. But we are hearing directly from CEOs, as you know, it's been earnings season. A lot of them are asked about returning to work and that situation. Christian Sewing, the Deutsche Bank CEO, says we'll certainly change the way we're working. He sees a lot of opportunities to cut costs, commercial real estate costs and other costs. Dan Pinto, the co-president of JP Morgan, which is the largest U.S. bank, says he foresees a portion of their staff working from home on a rotational basis permanently going forward. They might have groups A, groups B, groups C of their staff rotating into the office, but they might look to do that permanently. He says that cuts costs, it supports their sustainability efforts, reduces the demand for office space. Speaking of office space, Jess Staley, the Barclays CEO, says the notion of putting 7,000 people into one building may be a thing of the past permanently. All of them are talking about, as all CEOs are thinking about how to bring some people back to work. They're thinking about spaced seating in their offices. So you may not be sitting right next to your lovely colleagues, Susan or Sharon or Alex or Andrew again. You might be 6 feet apart, 2 desks apart. Mandatory face masks potentially in the office, and temperature checks, temperature screenings as you enter the lobby. So definitely the nature of work will change, and some pockets may look to make those changes permanently.
Yeah, I do have to say that I think in particular, I always peruse the LinkedIn feed every morning. And I will tell you that the technology used to communicate with people needs an upgrade. We're talking on an over-the-top virtual platform. A lot of people are rolling out webinars, Devin. And webinars are like so late 90s, early 2000s. I think that's an area where we can do a better job really reaching each other, communicating, and creating that sense of community. And we've covered that earlier, late last week on the network, about event services and conferences looking to replicate that type of feeling. And certainly you can get close to it, but you can't certainly replicate the feeling of being with colleagues and slapping people on the back, or high-fiving, or doing chest bump or the fist bump or whatever. But I think that's an area that certainly there's some expenditure needed. Devin, always a pleasure chatting with you. Take care, stay safe, and of course, we'll talk to you again next week.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. But as you know, we're not done for the week, because tomorrow we've got our weekly show, BRN Weekly, and I'll be joined in the first segment by Betsy Mayotte. She is the founder and president of the Institute for Student Loan Advisors. We'll be talking about the coronavirus's impact on student loan debt. You're not going to want to miss it. So until then, stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.